Money Show.
Personal Finance with Warren Ingram.
Before I get to you, Warren, 79 minutes gone, 3-0 to South Africa, to Bafana Bafana in their game against South Sudan. Warren Ingram, certified financial planner at Galileo Capital. I don't know if he's a certified football commentator, but we'll give him a go if he's keen. Warren, good evening. You want to focus on the one big decision you want to make when you want to invest. We talk about investing with so much complexity. Here you are reducing it to one big question.
You know, the thing about the world of investments is that we have an enormous number of very bright people all around the world who study the investment markets in minute detail. And now, you know, to add to that, they've programmed very sophisticated algorithms to track the markets even more. And then we've got this massive news engine, you know, whether it's on social media or in the mainstream, creating enormous amounts of content, and it all gets thrown at us multiple times per minute, per day, per week, etc. And so we start to think that this must be a very complex business, this investment thing. If that was true, Stephen, I would be doing something entirely different, because I don't have the ability to deal with too much complexity. So we need to understand that there are ways to make investments complex, and I think that we see product providers and fund managers and stockbrokers and derivatives traders and hedge fund people and now crypto people creating complexity. But for us as ordinary individual investors, we need to do one thing. We need to really get one big decision right, and then we can allow everyone else to get on with all their complexity and you know, feel like they're conquering the world while we get on and build our wealth. And so it is true. I think we just have to do one thing. We have to get that mix of assets correct for ourselves. And what I mean by mix of assets is that combination of cash, bonds, property, and shares. If we get that right for our own requirements, we have won most of the game already. We've already scored 3-0 if this was a soccer game, and it's already only the first 5 minutes.
Okay, so obviously these asset classes all have different advantages, and to an extent, some disadvantages as well.
Yeah. So maybe let's, I always like to think of investments in the same way as constructing a car. So we all want to go, from point A to point B as absolutely fast as we can. The truth is that we won't get from point A to point B if we don't have things like brakes and suspension and shock absorbers as well. So the thing that gives your investments the vuma is certainly the stock market. That would be investing in shares. And there is an argument to be made for just putting all of your money in shares and not worrying about anything else, because that's when you get maximum vuma. And that's true until the stock market falls over, and then you get maximum vuma all the way down as well. And so we're not really designed as human beings to deal with investments that can go up by 50% in a year and equally could lose us half our money in a year. It just somehow we don't find that to be a great experience for some strange reason. And the reality is, if you're retired and you're drawing money from your pension and it halves almost overnight, it's just not a journey that most of us can tolerate psychologically, and certainly in our finances would be almost disastrous. So that means we need to add some other things to the whole car, and the first one will be some cash. And cash for me is the same as brakes in a car. It's the thing that gives you the safety net. It's never going to get you anywhere fast, but it might make sure that you don't go off the edge of a cliff. And so cash is a great stabilizer. It's a great antidote to the uncertainty of stock markets, but it's not there to give you anything other than safety. It's certainly can't be the entirety of your portfolio, because then you will always feel safe, but you will go nowhere. And so we've got to add two more things to our mix. And the one is then you'll often hear people talk about fixed income or fixed interest or bonds. And simply put, bonds are the things that generate some long-term capital growth and some interest that might do better than inflation, and certainly won't give you the growth of the stock market, but it performs in a different way and at different times. So it becomes the shock absorber of the portfolio, in addition to cash. And then you get property, and I'm not really talking here about just buying a house and treating that as part of your investment. I'm talking also about real estate companies. These are companies that trade on the stock exchange, own most of the big shopping malls and office parks and logistics hubs, and again performs in a different way to the normal stock market. And if you put all those together in the right mix, then you start to give yourself the control and the direction you need to get from point A to point B.
Okay, so when you talk about real estate, you're not even talking about your own home. You're not talking about buying another property yourself and renting that out. You're talking about investing in companies that do that.
Exactly right. And some people might well decide to build up a portfolio of properties as well, and that's okay. But it needs to form part of a mix. So the thing that bothers me when we talk about real estate is that everyone's got an opinion on maybe you must buy 5 properties and rent them out, and don't let some landlord make money off you. And the thing there is that they don't realize then that they've got no other mix in the portfolio. There's no brakes, there's no shock absorbers, there's no suspension. They've just got every single egg they possibly can find, and they've put it into one basket, and then they hope, and that's all it can be, is hope that they will achieve a good investment outcome over time. So it's not to say that you shouldn't consider property as an investment class. I think it's not a bad one. It just really cannot be your only investment, because other than your home, you might then decide to buy another property, and then all of a sudden what you've got is maybe a small retirement fund and enormous property exposure and nothing else. And I think that's a huge mistake. So if you want property exposure, really consider property companies that trade on the stock exchange, because the big ones own hundreds, if not thousands, of properties in many different sectors right across South Africa, and nowadays right across the globe. And that to me feels like lots of eggs in lots of baskets.
011-883-0702, 021-446-0567. Your questions for Warren Ingram this evening on personal finance, and of course talking about the one big thing you have to get right. Okay, the big benefit of getting the asset mix right. I mean, the big advantage of that. Why is that so important?
Well, let's consider what's going on around us for the last little while. There's been this major election in the US and ratcheting uncertainty about what's actually going to happen. What is the new government in the US going to do from a policy point of view? What are they going to do with tariffs and all of those things? And I can confidently say I have no idea. And if that's the case, I also don't know that what's going to happen in Russia and the Ukraine, and I don't know what's going to happen in the Middle East. So the uncertainty levels are sky high right now, and I can't control any of that stuff. But what I can do is I can say, I've got another 30 or 40 years, I hope, of life left, and I would like to invest my money in such a way that I get some good capital growth and I beat inflation over that time, which means I need a chunk of my money to be in the stock market, and so that's one big call. I'm going to say probably 2/3 to 3/4 of my money should be in shares, and then I need to get a nice spread between cash, bonds, and property companies with the balance. If I get that decision right, and I keep that mix the same in maybe checking it every January and every July as an example, so twice a year, I don't need to worry about what's going on in the world and who's doing what and what president is deciding to do what policy. I just need to focus on my asset mix, and then I don't get caught up in the hopeless game of market timing or trying to pick the assets that might do well if this happens or might fall over if that happens. All I do is focus on my asset mix. That allows me to ignore the emotional aspect of getting involved in what's going to happen into the future, and gives me a huge advantage over the institutions and pension funds that spend their lives, creating complexity and often making very big decisions, and often getting those very big decisions wrong because they're based on forecasts, on predictions. So it allows you to get out of the game of forecasting, of predicting. It allows you to stay focused on the most important decision, and hopefully have a much more pleasant, serene way of investing money, which is key here. We can't be swayed by our emotions, because emotions destroy our investment decision-making ability.
Okay, so then how do we go about getting this right? I mean, what sort of factors do we consider? How do we start the process of making sure we get this big decision absolutely correct?
I think the first is you need to figure out how much can you afford to lose when stock markets are going down. And that might sound like a silly question, because I've never met anybody who says, well, I'm very happy to lose money. No one's happy to lose money. So it's more about what's your tolerance for risk. In other words, if you're looking at your statements and let's say that you started the year at R1 million and now they're sitting at 850,000 Rand. Would you be comfortable leaving the investment and not doing anything, not making any changes, because you believe it will recover and continue to deliver growth? If you do, that means you can tolerate a loss of about 15%. That's important, because that means that you can allocate a fairly large proportion of your investments to shares. However, if you're going to look at a statement and have an absolute freak out when you lose 5%, on R1 million, that's not a lot of money to lose, then the likelihood is that you should only allocate a small portion of your money to shares, because you don't have the psychological tolerance for risk. So understanding your own tolerance for risk is possibly the biggest decision you need to get right up front, because that helps you determine how much you can put in shares. And then it's about the goal, Stephen. So if it's about saving for a car in 3 years' time, well, you shouldn't put any money into shares, because that's a short-term goal. That means you should put it all into cash. If it's your retirement and that's 20 years away, then you can put a large amount into shares, remembering rule number 1, which is how much can you tolerate? How many of the losses can you deal with before you're going to freak out? And then my last comment is, remember that this investment business is not your sport. It's not your hobby. It can't be the thing that gives you entertainment, so that you become tempted to look at your app every day to see how much you've gone up or gone down, and kind of bragging to your friends, whether it's on social media or on the braai. What you need to know is that delivering good investment returns over long periods of time for yourself should be pretty mundane, pretty boring, and it should be about getting that asset mix right. In other words, it should be systematic. It should not be exciting. If you're getting a lot of excitement from your investments, I want to tell you, I think you're doing it wrong.
That's so interesting, because, people get the high of watching their money grow, but actually, it should be growing consistently at a low rate that there's not much of a high. It's just growing consistently.
Exactly right. It really should feel as if you add one pebble to another, and every day you walk past, you drop another pebble on the ground, and when you kind of look back one day, you've built yourself a nice mountain, and you've never done it in one big leap, and you've never done anything spectacular in any one day. But what you have done is be consistent. So adding some money to investments every day, and then leaving them to do their job is critical. And trading your investments and taking action based on what you hear or what you read, feeling an impulse, whether it's fear or excitement, all of those are really bad ways to make investments. And unfortunately, a lot of people, both private investors and professionals, do that. They get severely influenced by what's going on in the very short term. And your impulse to do something, it always narrows your time horizon right down. And if you want to be rational and think in the long term, you just can't be emotional about your money.
We have a question for you from Benjamin. Benjamin says, "Hi, Warren. I'll be inheriting a holiday home from my dad's estate. I'm not keen on keeping the property because I don't plan on using it often. I also know it costs a lot to maintain. I've chatted to a few people. They think it's a good idea to keep it and rent it out when I'm not using it. What are your thoughts?" That's from Benjamin. We'll put that question to Warren Ingram in a moment.
The Money Show.
Personal Finance with Warren Ingram.
6 minutes to 8. Warren Ingram, co-founder of Galileo Capital, with us this evening. Warren, such an interesting question from Benjamin. He's going to inherit his father's holiday home. He thinks it's going to cost quite a lot. He's not planning to use it. Should he be renting it out? Should he be keeping it?
It is a fabulous question. The idea of a holiday home is so romantic. We if we start the year and we're kind of a bit bleak to be back at work, and then we think, well, it's okay. We've got this holiday home. We can start planning our holidays, and we know exactly where we're going to go, and it's all lovely. And for a lot of people, they do get a lot of enjoyment out of the holiday home. The other side of that coin is, somewhere in that year, especially if it's, in a fairly kind of exposed place, if it's on the coast or, high in the mountains, etc., what's going to happen is you will need maintenance, and it costs quite a bit to look after a property that's not lived in all the time. And so what happens is the holiday house very quickly goes from being this joyous thing to a burden, because when you get there, you're not, relaxing on the beach or sitting in the hammock. What you're doing is you're on the roof fixing the leak, or, sanding the whatever it is, and cleaning the floors, etc. And so it becomes both a financial burden and a time burden. And so I'm very skeptical of the idea of having a holiday home just in general. I think it's often a waste of capital, and secondly, a huge consumer of time. So I think Benjamin's skepticism is probably right. It's people giving you advice about this. They're kind of caught up in the romanticism of a holiday home, and it sounds so easy. I'll just rent it out. I'll put it on a website, and lots of people will come in and rent the property, and it'll pay for itself. Well, that might be true, but equally they could cause damage, or they could ask you to restock the house with new furniture or new linen or whatever it is. And what you find is every 6 months you're working on your new job, which is keeping the holiday house ready for other people. And actually, when you look at your costs, and you look at the income you're making, it's probably not going to be that attractive, because there will be long periods of time when you're not going to make money, whether it's midwinter or whatever the deal is, when people don't want to rent it. And so I think that you need to do the calculation very carefully. If you're going to do this, number one, don't go and ask a letting agent, because what they're going to do is they're going to tell you the best story they possibly can, and it might not be an accurate reflection of what you could get from your property. So it's very important to ask other homeowners in the area, wherever you have this holiday house, what they get from renting out their place. And it can't just be the time over Easter and maybe over December when rentals are amazing. You need to get an average number over a year, and then work out what that income is. And then, Benjamin, you really have to look at your costs. How much is it going to cost you in normal taxes and all of that, plus maintenance? And then work out after those costs, is it still a decent idea, or can you sell the property and rent a great holiday house that someone else is maintaining for you every couple of weeks, and invest that money into your long-term financial future? And I guess it's probably not a surprise, Stephen, where I'm landing. I'm landing on, unless the numbers are amazing, sell.
And of course, you can sell, and then you could reinvest the money in all sorts of ways, including your own bond.
Exactly, and then you're not compelled to go to the same property over every single holiday, which is sort of what happens if you have a holiday house. You feel guilty when you then pay for renting a holiday house somewhere else or doing something else, because now you've got this holiday house that you really should be using. And so I think putting the money in your bond, putting it into your savings, to me gives you a lot of freedom.
Warren Ingram, thank you very much indeed. Certified financial planner, co-founder at Galileo Capital, and a very interesting question to answer to Benjamin's question. Of course, the focus tonight, the one thing that you need to get right, all about your investment mix. Warren, of course, as always, podcast for you. If you miss it, if you think there's someone in your family who maybe needs to hear what Warren has to say, maybe find it on the podcast and WhatsApp it to them.